Isn't it also a function of liquidity transport, right? You're taking
Yeah.
liquidity from one market where it's robust and moving it to another market that might be less robust.
Yeah, was it not maybe Myron Schultz? He talked about omega, right? Like if people talk about alpha and beta, and the Chicago school doesn't believe in that, so they said omega would be risk transfer services. That's what you get paid for. Is liquidity is another way of saying inventory and liquidity is a risk transfer service. So omega is actually the only way to actually derive alpha. But I'm curious, like how you guys think about this is like with balancing. I always think about it scale trading the equity curve. Like I think about way back in the day when I first found about trend following decades ago, I was like, why wouldn't you scale into their equity curve, right? As trend followers, if you believe in the strategy, believe in the manager, and when they're in drawdown, why wouldn't you be scaling into that equity curve and scaling out at new highs? And like that's going to smooth out your equity curve. So it's like scale trading the actual equity curve of the strategy. So when you have this broad diversification across asset classes and you're rebalancing, you're scale trading those asset classes. But as Rod just referenced, is the implicit assumption is mean reversion, right? And this is what I'm really curious about. It's like everybody says, well, and mean reversion can happen over long stretches of time across asset classes, but sometimes asset classes trend, and that's when you don't want to be rebalancing. But I'm not so certain of that. And what I mean by that is like by rebalancing, even if it is in trend, it's not as beneficial as a mean reversion environment. But when it's in trend, you're still monetizing the trend and you're taking from your winners and giving to your losers. So like, even though it's trending, it's not perfect for rebalancing. You'd prefer mean reversion, but I'm curious about like, to me, it's like micro monetizing the trend though, when things are trending though too. So like you're actually gaining profits where if you just let those trends go and you weren't rebalancing, like we're saying, like now you may be in a left skew kind of trade.
Is that sort of like value averaging? It sounds to me a little bit like the concept of the value averaging concept. Remember the book?
Yeah. The retirement scheme,
yeah.
The retirement accumulation strategy. Yeah. I do wonder whether the rebalancing, let's call it the diversification premium. So Corey doesn't come through the screen.
He's gone now. He's bored. He's out.
Or omega, whatever. I don't know that the assumption is mean reversion so much as the assumption is you have two uncorrelated assets, and over time, I mean, I know Shannon Zeman, you could theoretically have two variables that are sufficiently uncorrelated or negatively correlated with sufficient volatility to be able to generate a positive omega, even if both of the variables have a negative expectancy. Mm-hmm. But in real life, the high enough variance will overcome the probability that you're going to generate positive growth on two ultra high variance markets. And so, like, I think the reality is in investing, you've got markets that are either expected to just be kind of random Brownian motion with zero drift, or so like, let's say commodities in real terms, or you're going to own a large variety of instruments that all have positive drift, and you're rebalancing between them in order to maintain an optimal diversified portfolio. In other words, you're diversifying to the greatest extent possible to minimize variance drag. And so you need to diversify, you need to rebalance in order to preserve optimal diversification.
Define why variance drag is a bad thing, just quickly, just in case.
Well, it's the idea of, like, just to keep it simple, if you got a market that goes up by 50% and then down by 50%, you're not at zero, right? You're at some number below zero. And it's because the compounding effect of gains is different than losses, right? So if you've got an asset that moves from A to B in a straight line up with no variance, oh Jesus, I don't know how you describe this in a way
Look,
that...
the simple
Well, it's simple. Yeah, the simple thing is if you go up
that-
50%, you're at $150. You go down 50% from there, you're at 75.
Exactly.
Yeah. But the
That's
other thing is
variance
just like if you just want
Exactly.
the mathematical entity is your arithmetic return minus your half your variance,
Half
right?
your variance,
So that's what you're actually going to have in your pocket as a compound rate of return. So the more your variance, the lower your actual geometric return versus the arithmetic return. So the more variance bad, diversification good. Diversification minimize variance.
There's
you want
two
to
caveats,
capture
though.
the maximum amount of drift
Yeah, there's
Yeah.
variance.
while
There's
minimizing
variance for sure.
while minimizing total portfolio variance.